Welcome back. Today we're going to be talking about Hyperliquid, ASTER, and all of these perpetual future DEXs that are launching and how this could be the thing that takes crypto down at the end stages of this bull market. Now, you guys know if you watch my videos, kind of where I feel we are in the cycle. I mean, we're already 18 months after the Bitcoin halving. If you look at the halving tracker, you can clearly tell and see that basically days since the halving, we are now approaching the 550-day mark after the 2024 halving. And based on the previous two cycles, this is at the top and potentially past the top in the cycle. And so we're starting to see other signals. And one of those signals I'm going to show you in this video from Arthur Hayes, where he's talking about his thesis on Hyperliquid, on these perpetual DEXs, and really on where the cycle is. And you guys know, I really agree with a lot of what Arthur Hayes has said. He's been right more than he's wrong in his statements about where the market is and where the market's going. Now, whether people are interpreting his analysis the way that he means it or not, that's a whole different story. But we are very on point with what he is saying. And in today's video, we're going to be exploring this whole perpetual DEX situation, ASTER, the Hyperliquid coin, and others, and explain how this could potentially take down all of crypto while making people very rich just on the trading from all of this perpetual DEX activity. This is the Cryptoviser podcast. Make sure you guys are subscribed to the channel. Every single day on this channel, we upload videos to bring you the latest happening in the financial world. Sometimes we do deep dives into individual cryptos or categories or things happening in the market. And sometimes we just talk about the macro environment, zoom out and understand everything that's happening in the financial markets and the crypto markets. So give the video a thumbs up, hit the subscribe button, join the channel. And we don't just talk about crypto, we also talk about stocks and traditional finance as well. So let's get right into it. Now, before we go to the perpetual DEX thing, I want you guys to watch this video with me. And it explains how cash is different than digital money, right? Because cash is just a form of exchange, right? If you pay for something, you're just giving them the dollar, they're taking the dollar. There's no intermediary involved. Once you add the intermediaries, like banks, like DEXs, like Coinbase, Gemini, Binance, right? Those are the intermediaries that are selling you the item. And they're taking a cut from what you're doing. So they don't care, like banks don't care whether you leave your money with them or not, but they want you swiping your card because they make money off of that. They want you writing checks, they make money off of that. They want wire transfers, they make money off of that. They want money orders, money off of that. They make money on every aspect except for the cash. Let's watch this video and you'll learn a little bit more.
If you have $100 bill and you spend it at the local takeaway, and that person spends it on groceries, and then that person spends it on new shoes, the $100 bill is still $100. But if you pay with card, the bank takes 1.5%, then another 1.5%, and then another 1.5%. After 20 or 30 transactions, the only ones left with the full $100 are the banks. That's why they want to get rid of cash. If you have a...
And by the way, this relates to crypto as well. What has been doing extremely well in this cycle? The Bitcoin mining companies that have pivoted to AI. Why? Because they are the infrastructure layer. OpenAI doesn't make any money. Google Gemini doesn't make any money. XAI doesn't make any money. None of the software developers of these large language models, of the AI themselves, are making any money. The people who are making the money are the infrastructure layers. It's the same thing in the gold rush. People who mined gold, they made money, but you know who made more money? The people selling the picks and the shovels. And that is where this whole conversation is going to culminate about the perpetual DEXs that we see here. Because there's a lot of focus on ASTER right now, on Hyperliquid. And in my view, we've talked about this on the channel, Hyperliquid literally means, it's in the name, hyper liquidation. That is what perpetual DEXs do. A perpetual decentralized exchange, or a perpetual DEX, is a platform that allows users to trade perpetual futures contracts directly from their crypto wallets without needing an intermediary. Unlike traditional futures, these contracts have no expiration, enabling traders to hold positions indefinitely. Perpetual DEXs are a core part of DeFi, and they allow traders to speculate on an asset's future price using leverage. And so they're not technically considered an intermediary, but the DEX is the intermediary. They make money on the fees, on the transactions, and the volume. And so they're making money whether you are or not. But it gets even worse because, number one, perpetual futures and perpetual contracts, whether it's on Coinbase or a DEX, because Coinbase and Binance, all of these have perpetual futures. But a DEX is like, they're saying they're decentralized, even though they're not. But these are making money, and they're not even touching like when you are trading on a perpetual DEX, and let's say you're long a specific crypto or you're short a specific crypto, it's not actually trading the crypto itself. So you're trading on a derivative, right? It's like a side bet basically that's not connected to the actual crypto. But what do we see occur? The leverage is the problem. Because once things get over leveraged, and they will, and I'm gonna show you this in just a second here. Once things get over leveraged, and there's a slight move to the downside or to the upside, opposite what the trade is, it liquidates people, and then it creates panic in the markets. This is why we see futures and options contracts. They're derivatives of the underlying asset, whether it's a stock or crypto or whatever. Now, technically, the underlying asset should derive the value from the asset, and the future option, it derives its value from the asset. But what has happened is these futures products now determine or dictate the market all over. Because, for instance, let's say Bitcoin is at $200,000, and let's say the futures contracts are starting to price in a major drop in the market. Then people holding the actual asset are like, wait, what does the futures market know? What do the billionaires know that they're counter trading this? And then people out of fear start dumping their positions. But what also happens then is, let's say the market moves and your position gets liquidated on the perpetual contract or on the futures contract or on the option. Well, options won't get, but you guys get it. On a leverage position, you can get liquidated. Once you get liquidated, it creates a market sale order. And then that creates more liquidations. And then the price goes down even more. And then more liquidations and more market orders and more price down. And it just creates a price spiral to the downside. Guys, we saw this in the previous cycle. All of the exchanges, Celsius, Voyager, 3 Arrows Capital, Terra Luna, BlockFi, FTX, they were all trading the market on very high leverage. And they were all losing money when the market started dropping. And then they started doubling down and increasing their leverage to make the money back, right? It's like you go to a roulette table and everything's red, and then you bet on black, and then it's red again, and then you double down and it's red again, and you double that and it's red again, and you keep doubling. That can go on forever, and you could lose everything. And when you're on leverage, the amount of the drop can be very, very small. For instance, if you have 100x leverage, that means if the asset moves against your trade, just 1% liquidation. 1%. And in crypto, we see massive moves in the market. And so what does the actual leverage look like? Well, if we look at hyper liquidation, they allow 40x leverage. Jupiter, 100x leverage. ASTER, this is the new one, 100x leverage. And so every single cycle, by the way, we don't see this kind of leverage in bear markets. We don't even see this kind of leverage in the uptrending markets. This kind of leverage starts to occur when the market is turning. Hence, we're at the end stages of the cycle. Because, again, these platforms that are allowing this kind of leverage, they make money either way. They don't give a shit where the market goes. They don't give a shit how many people get liquidated. They don't care. They make money on the fees. They make money on the transaction volume. Even if it's a small percent, they do not care. They're making money regardless if the market goes up, if the market goes down. And you know who's trading the market? Greed. That's what's trading that market. And so this only happens at the top because people are willing. They're the most bullish they've ever been. I mean, we've seen this from $110,000 to $125,000 People they are the most bullish they've ever been. They weren't bullish at $15,500. They weren't bullish at $50,000. They weren't bullish at $60,000. They're the most bullish they've ever been at the top of the market. And so they have the confidence in their belief that the market is nowhere near a top, that they're willing to put 100x leverage. And you know what these DEX is and these these futures and perpetual contracts like providers say? Sure. However much you want to trade, we'll let you trade it. Because again, they make money regardless. And so why didn't we see 100x leverage in the bear market? We're seeing it at the literal top of the crypto market, right? And so who's trading 100x leverage? It's not Wall Street. It's not big money. I mean, guys, think about in the last cycle, Celsius lost a lot of money trading their customer funds. And then what did they do? They doubled down and traded even more because, the market is definitely not at the top. We got to double down now because we'll make our money back. And then the market keeps going down. Then they lose again. Then they double down again. And that's why I keep saying now in August, September 2025, there's people who are multimillionaires currently, maybe even in cash, maybe in cryptos. It doesn't matter. By next year at this time, they're going to have nothing because they're going to overtrade the market. And they're going to get so confident that every dip is a buy the dip moment, they're going to start adding leverage. And the more leverage they add, the more of a guarantee that the market will fall. And by the way, it's not just me saying this because there's other factors at play here as well. There's a lot of other factors at play. And people are not looking at the tokenomics. They're not looking at the prospects, the prospectuses, or the, whatever you call it, the disclosures from these publicly traded companies. They're not looking at it. So they're just trading because they feel the market's going to go higher. They feel we're not at the end of the cycle. But what you can clearly hear in this video from Arthur Hayes, he believes that Hyperliquid is going to continue to go up over the course of time. But in the short term, he believes that there's a major downside risk here. So much so that he dumped all his Hyperliquid coins. Let's listen to what Arthur Hayes says. Sorry, the sound is off. And also, while we're going to be playing this video, just think about the leverage that people are playing to counter trade what Arthur Hayes is saying. He's talking about data. He's not talking about, I think that we're going to have a higher market. Or I think that the bull market is not over. I think that we're not going to have a 4-year cycle. You can think whatever you want, but the market is telling you what the market is telling you. Let's listen to what he says.
Hype has the potential to go 120x, 26x. Now, the key point here is by 2028. We are in 2025 right now. And a lot of things can happen between now and then. And as a chief investment officer of a fucking hedge fund, I go long and I go short, even though I might have a conviction on a long-term state of play. Bingo.
There's people who are like, but Cryptoviser, Bitcoin is going to go up over the course of time, or this crypto is going to go up over the course of time. And I agree with that. Like, I think Bitcoin will hit $1 million, like relatively soon, like within the next decade. But that doesn't mean that we're not going to have corrective phases. That doesn't mean that this leverage needs to be wiped out. That is literally the case. Let's continue listening.
And so right now in the short term, we have an issue where Hyperliquid is facing its Chinification moment, where they're going to have competitors who've seen a successful business model, and they're going to say, okay, great, now I'm going to take your price down to zero and see how you survive. And they have this massive potential sell pressure coming starting in November.
Now, before I continue, he's completely correct, right? Because they will be tested. It's either a pumpamental or a fundamental. And the drawdown in the prices of these coins, of these ecosystems, that is the test, right? Oh, you think that the market is going much higher? You're going to put 100x leverage on your bet? Great. We're going to take that money and see how you're doing. Because if you're going all in on a 100x or a 50x leverage trade, Wall Street, the market makers, they're going to take your money because they understand where the cycle is. They understand the tokenomics. They understand the unlock schedules. They understand the insiders that are going to sell. They understand the counter traders. They understand the market cycle. That's the bottom line. So it doesn't matter how you feel. It matters what is. I mean, even after Celsius went down, Voyager went down, 3 Hours Capital went down, Terra Luna went down, people were still putting 100x leverage in. And I'm like, the collapses haven't completed yet because you're still playing this 100x leverage. Nobody plays 100x leverage in a bear market. They only play it in a bull market. Let's continue listening.
I don't know how many of the developers are going to sell, if at all. But if I'm going to think about the model, I'm going to say, well, okay, do I believe that Hype has the moat in terms of revenues to make enough money so that they buy back enough Hype tokens where this doesn't matter? And before, this weekend when I pulled up the DeFi Llama leaderboard and I saw that Lighter was number 2 and Aster number 3, both doing, $2, $3, $4 billion ADV days, and Hype was only about 4.5 billion. I'm like, okay, well, this isn't good. I need Hype to make money. Because when Hype makes money, then they buy Hype, and then I don't care about the unlock.
Bingo.
But if there are these people that are going to say, I'm going to go and pull we only care, we'll make it up in volume in the back end. I'm going to go zero fee trading, see if I can get all your users, Vampire Squid attack you, do an airdrop so that people can do another 10, 20x on their airdrop, then I'm worried that Hype might not have enough money to buy back enough tokens to offset this potential negative drag on the very publicly known unlock schedule. And I said, okay, cool, I'm going to exit. If Hype goes from 50 to 100 and I'm wrong, great. Still think it's going to 5,000 in 2 years. If Hype goes from 50 to 25 and I'm right, great. Now I get to buy back at 25 and I get some extra use in my returns. And so that's why I'm thinking as a fund manager in terms of the probabilistic outcome and what's my best expected value decision. And that's why we sold.
Bingo. Bingo, bingo, bingo. And this is how the big money thinks. This is how you heard it directly from Arthur Hayes. They need to make money. And if they're making money, they're going to do fine. But now there's competition. Now you have ASTER. And now you have CZ saying, wow, now everybody wants a perpetual DEX. More players will grow the market size faster. Rising tides lifts all boats. Long term, the best builders win. And that's true. The best builders will win. But you also have so much competition. And before, it was really Hyperliquid. That was it. Now you have Hyperliquid, ASTER, all of these other ones that are providing even more leverage. So now they have to split that volume, split that revenue, split the earnings. And that effectively, think about it. If you're the only company that is, providing AI infrastructure, of course you're going to do well when the demand is very high. But then if there's 15 competitors that pop up, now you're sharing the revenue with 15 competitors. No matter how good of a business you are, people are still going to go to competitors as well, especially if they're offering more leverage. Gains trade, they have 500x leverage. And so what creates all market downturns? Over exuberance, over leverage. I mean, you literally heard Michael Saylor in previous years saying remortgage your house and take the money and buy Bitcoin. That is leverage. You may not look at it that way, but it is. Now, whether it's a good trade or not, I mean, only time will tell, but are you going to risk that just to get more Bitcoin and think that we're not going to hit a bear market? And so we also are now hearing about Fogo, which there's not really that much info on, but apparently it's going to be the, quote, fastest layer 1 blockchain. It's a Solana-based ecosystem. They don't even have a white paper yet. If you click white paper on their website, it says white paper update coming. They don't even have a white paper. But meanwhile, Fogo is at the basically end of September, they had a conference in South Korea. And this was going on at the conference. This is one of their, promoters of it. And they're dancing to Gangnam Style. Okay, so this doesn't happen in bear markets. This only happens at the top, right? I mean, yeah, granted, they could just be having fun, but You don't see this in a bear market. You don't even see it in an uptrending market. These are top signals. And so in my view, all of these perpetual DEXs that are launching, they're going to do round trips from a price perspective at some point. Like even Arthur Hayes said it. He said they're going to take your coin to zero and see if you can still survive. Because if the only thing that your ecosystem is driving is the valuation going higher because it's a new coin and because it's a new ecosystem and because you're making money now, well, what happens in a bear market? What happens in a downtrending market? What happens when leverage is wiped out and people have no more money to trade because they over traded the market? And this happens every single cycle. And the thing is, it just becomes more and more easy to identify because there's less and less. There's a reason in the United States, the regulators do not allow 100x leverage. I mean, I don't even think that they allow like over 10x leverage. Like go to Coinbase perpetual futures and look at the perpetuals. I think the max leverage is like 3x or something like that. And I would imagine the other regulated exchanges is very similar as well. But meanwhile, in these DEXs, you can trade whatever you want. Why? Because they're going to take your money. You think that Arthur Hayes is trading on leverage on Hyperliquid? I would highly doubt it. He's trading the infrastructure. He's trading where he can get the money from, and you heard it from him. And so in my view, these are top signals. And the more and more leverage that's put in, and I would say the more the market downtrends, and we do start heading into the rotation phase into the bear market, the more leverage people are going to use. The more leverage people use, the more you know they effed up their trade. Because we saw it in the last cycle. All of these exchanges that went down, they were trading on leverage to make back the money that they lost. And then they lost even more on that double down. And then they do more leverage and they double down there and they lose again. And granted, maybe not every single one will, but the more people trading leverage, the higher the risk of more losses. It's like going to a casino. The more people you see in a casino, the more money the casino makes. It doesn't matter how many people are winning, they still are going to make more money. Because the games are geared for the house winning. And leverage is not geared for the majority to win. And most people who are trading with 100x leverage, they don't know what the hell they're doing, right? You don't see Wall Street trading 100x leverage. There's no need to. But the ones who do typically get liquidated over and over and over. And the DEXs, they don't care because they're making money regardless. So let me know what you guys think about this whole DEX situation, the perpetual futures on the DEX, and whether you think that this is a positive or a negative to the market. And remember, with the video that I showed you at the beginning, it's all about the fees. They're making money whether you're winning or losing. They don't care. They make money on the way up. They make money on the way down. But who gets the end of that stick? The greed. The people who are getting greedy and trading that 100x leverage. Like, oh yeah, Cryptoviser's an idiot. We're not at the top of the market. We're going way higher. I'm going to go 100x leverage. Okay. You're going to get liquidated on a 1% move. Bitcoin at $100,000, a 1% move is $1,000. And your whole position's poof, gone. So trade responsibly, do your own research, and let me know what you guys think down below in the comments. While you're down there, give the video a thumbs up, hit the subscribe button, and check out our other videos on the channel. See you guys on the next video. Crypto on.